Welcome. Today we're going to be talking about the RSI, the Relative Strength Index. So what this is a momentum indicator that's going to measure overbought and oversold levels. It's an oscillator and it's bounded between 0 and 100, and the standard time period that's used is 14 days. What this is made of is the relative strength, and that's a ratio of the average and current gains and losses. And the RSI uses a formula to set that value between 0 and 100. Because it measures the gains and losses against each other, the RSI is going to be higher when the security is recorded more gains, and it's going to be lower when it's recorded more losses. And you can see here, we have CVS on the screen and the price is rising, and you can see that the RSI has higher values, right? We're between 50 and 85 roughly. And then when it starts to drop off, this value of the RSI is declining, and then it goes below 50, all the way down to about 31. So how we're going to apply this is using some of the signals that it can provide. And the first two pieces we're going to look at are these two lines. We have the 70 line, and then we have the 30 line. And anything above 70 is considered an overbought position, and anything below 30 is going to be considered oversold. And one way to use this that we've discussed before is divergence. And that happens when the security makes a higher high and the indicator records a lower high, or conversely, when the security records a lower low and the indicator records a higher low. So we're going to look at that here. On 10 May, you can see that CVS has hit a new high, and so has the RSI. And then again, on 18 May, securities recorded a higher high, and the RSI has recorded a lower high. And then what happens after that is you see the stock price drop as well as the RSI, right? And we have a drop from about 90 down to 80, right? So that's divergence right there. Another one we're going to look at is swing failure and rejection. And we're going to use a Canadian dollar and the US dollar for that. And the swing failure and rejection, that's going to happen over here, right? So we have the RSI crossing into the overbought territory and then dropping below. And then it rises again, but it doesn't cross into overbought territory. And then the RSI creates a new low, right? You can see that right here. And what happens a couple weeks later is you see the drop, right? And that dropped from about 82 cents down to 80. And so what that is that's the swing failure or the swing rejection is going to be an indicator of a possible reversal. And we saw that here. We saw a bearish case of the swing failure rejection. It also happens on the bullish side, and that'll be the opposite. That's when it's in oversold territory. It crosses above 30, drops again, but doesn't cross below 30, and then rises above the previous peak. Hope you all found that useful. Like and share the video, and let me know what y'all think in the comments.